Coming up on Retiring Well.
And when we took a quick look at it, we saw that they were paying about $3,500 a year just from taxes on their investment portfolio.
So I've got all this income stacked up, all right? And then over here, I've got this non-qualified account.
Every year you need to be looking at taxes, and most definitely now between 2018 and 2025 with these new tax rates.
Retiring Well, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well, where we believe your best is yet to come.
Welcome to Retiring Well. I'm your host, Michael Reese. We've got a wonderful show lined up for you this week. We are talking about taxes and paying tax, especially on money that you don't use. This is a big mistake we see happening all the time. In fact, we talk about it right here in our book, Retiring Well, How to Enjoy Retirement in Any Economy, #1 bestseller on Amazon. In fact, right here on page 95, there's a whole section here talking about paying tax on money you don't use. You don't want to do that. And let me give you an example here of what we're really talking about. So we had this couple come in the office, probably a lot like you. Anyway, they come in the office and we do an analysis or a review, a no obligation review, and one of the things they brought in was their tax return. And when we took a quick look at it, we saw that they were paying about $3,500 a year just from taxes on their investment portfolio. And we asked them, we said, well, are you spending that money? And they said, no, we just reinvest. Well, gosh, then why are we paying taxes? Why are we giving the IRS? Why are we sending $3,500 a year to Uncle Sam if you're not using the money? Over 10 years, that's $35,000. And you know what that was like? It's kind of like this happened in my life. I have 5 children. My middle one, his son, his name is Brendan. And a few years ago, he was, I want to say 15 years old. And Becky and I were sitting down in the living room. We're watching TV. And he comes home from work. We hear him go up the stairs to his bedroom. And next thing you know, upstairs, we hear the shower's turned on. And wow, Brendan must be taking a shower after work, we imagine. Well, then what happens? Then he comes pounding down the stairs. Shower's still running upstairs, of course. He comes downstairs. He opens up the freezer. He pulls out, the standard fare of a teenage boy, a frozen pizza. He pulls it out, turns on the oven, and proceeds to lean over the counter and just kind of hang out there. Meanwhile, the shower's still running upstairs. So my wife, Becky, looks at him. She says, Brendan, what the heck are you doing? And like any teenage boy, he looks at her, he says, making a pizza? Right, I'm making a pizza. And Becky says, well, isn't that the shower I hear running upstairs? He says, yeah. And Becky looks at him like, well, go turn it off. And he literally looked at her and goes like, why? Because you're wasting water. Well, guess what, folks? When you're paying taxes on money you don't use, you're just like my son Brendan, because those taxes are raining down on your money 24/7 and you're not using it. Don't make that mistake. Don't be like Brendan. So we're going to talk about that on this show. We're going to have a great time. So don't go anywhere. We'll be right back.
Retiring Well is now also airing on radio, bringing you insights from Northern Michigan's financial advisors specializing in retirement planning. Every Sunday at noon on WTCM AM 580. Don't miss Retiring Well Radio every Sunday at noon on WTCM AM 580.
Retirement represents a fundamental change in your life. Yet most retirees don't match that with a fundamental change in their portfolios.
Centennial Wealth Advisory's core services are built around lifetime retirement income, fully integrated tax reduction strategies and portfolio stability.
Contact us today for a complimentary, no-obligation initial meeting. We'd be happy to learn about your vision of retirement and to share our insight with you.
Welcome back, folks. As you can see, I've got Larry Flynn with us. He is one of the lead advisors at Centennial Wealth Advisory, offices in Traverse City, Petoskey, Gaylord, all over the place up in northern Michigan. And, you know, Larry, we're talking about, from our best-selling book here, we're talking about paying tax on money you don't use, money you reinvest. Now, you have a long history. You've done taxes in the past. You've helped people with their financial planning. You're very familiar with this topic. So help us out here. What's happening? How is it that people pay money on tax they're not using? What's going on?
Well, Mike, think of it this way. So I've got my pension income, right? If I'm fortunate enough to have a pension, I've got my pension income. I may be drawing from Social Security, right? So I've got that income. I might be pulling income from my IRAs.
Maybe you're over 70 and a half. You got required minimum distribution.
I have to, right? So I've got all this income stacked up, all right? And then over here, I've got this non-qualified account, or what's non-retirement money.
Yeah,
right?
non-qualified. So money that was, maybe someone sold a house and they have some extra money that they invested or they inherited or something, but it's not in an IRA.
Right.
Is that right?
That's right.
Okay.
And what is it spinning off as far as income? Interest, dividends, maybe some capital gains, right?
Okay.
That's what. So you've got this income over here coming in, but I don't need this money. I don't, because I've got sufficient income being established with my pension, Social Security, and maybe the IRA money. And now I've got this interest and dividends I'm putting and stacking on top there, right? And I'm paying tax on that money at my highest rate.
Wait, so what's happening here is a lot of times, you know, if you've got that account over there you're talking about, Larry, I know some people I've spoken to in the past, but they would say, but Larry, no, it's not I'm not taking any income from that. So what are you talking about? You say it's spin-off income. I'm not taking any income. I'm reinvesting.
Sure.
Why should it be taxable?
Sure. Well, because Uncle Sam says that if it's spinning off income, guess what? You're going to pay tax on it today.
So the IRS doesn't care if you're spending the income or reinvesting the income. As far as they're concerned, you're paying tax on that income.
That's right.
At your highest rate?
That's right, because if I've got all that other income and then I put those interest dividends on there,
It's like on top.
it's right on top. That's right.
Oh my goodness. So you see people paying tax on money they're not spending. How often do you see that? It's pretty common?
Fairly common, yes.
So what are some options for folks? Like what are some things they could do to help reduce some of those taxes on money that they're not using, that they're reinvesting?
Well, one thing we have to give high consideration to is if we have those kind of accounts that are spinning off income that we're paying tax on but don't need to, is what's some other financial instruments we might use that might be more tax efficient?
Yeah, and it probably depends on the purpose, right? I mean, if it's money that's truly kind of extra money, you might use one type of tool. If it's money, or if it's money they say, you know, I don't need it today, but we expect to use this for income 10 years from now. It might be a different tool.
Right.
Right? So give me some examples of some different tools that are out there.
Well, one that comes right to mind is municipal bonds. Okay. All right. Some people like those because I'm getting an interest for income, but because it's municipal interest, I don't have to pay tax on that.
Okay. So that would be essentially tax-free types. Are municipal bonds typically really good investments today? Are they paying decent rates or not?
Probably were historically, because yields were a little bit higher. Today they tend to be a little bit lower, so that tends to be the challenge with them. Right?
Okay. What about, I've heard you say to me, Larry, you've told me about that ETFs are or can be tax efficient. What is an ETF? What does that stand for?
Exchange Traded Fund.
And is that like a mutual fund or what is that?
That's basically liken it to like a basket, and I can put any securities in that basket I want. But once I put them all in there, it closes. And now I'm just kind of like tracking it like an index.
Okay, so is that tax efficient generally?
Generally tax efficient because there's no buying and selling going on. You know, you're not incurring any what you call capital gains because I'm holding all the positions in there. I'm not buying and selling.
So if someone has mutual funds that are generating these dividends and interest and capital gains, maybe ETFs might be a good solution.
Yes.
Depends on the situation, right?
That's right.
Any others come to mind?
I think of Roth IRAs. You know, I love talking to younger taxpayers, you know, about Roth IRAs because they tend to be in lower tax brackets. They say, listen, if you're going to build up an account, you know, here's some tax deferred growth you can build up by putting them into Roth.
And then be tax-free later on.
Tax-free later on.
So there's a lot of different options here. Yes. It's just going to be different based on each person.
That's right.
Okay, fantastic. Larry, thank you. That was fantastic information. Folks, you don't want to miss what's coming up. We'll be right back. Here at Centennial Wealth, when we talk about your best is yet to come, what we're really referring to is that retirement is different today.
Retirement represents a fundamental change, yet most people don't match that with the fundamental change in their investments. Too often we see couples and individuals sticking with the same strategy that got them to retirement and not adjusting to a plan that will get them through retirement.
People who retire today are living 20, 30 years. And when you have that kind of time frame, you have the time to pursue the things that are meaningful to you, that are fulfilling to you.
In looking at your retirement income, you're no longer drawing a paycheck from the company you work for. Instead, you have to be the provider of that income. You don't want to leave this to chance, so we help clients evaluate all of their options to help provide the best solution based on their needs.
Most people in their working years put money into IRAs and 401ks because they wanted to push the tax off to their retirement years when they expected they would be in a lower tax bracket. Far too often, though, they find themselves in the same lifestyle, in the same bracket, and all they did is kick the can down the road.
Well, I'm happy to share with you, we have helped guide hundreds of families past that point into a future that is absolutely bright.
Although it's not fun to discuss, it's vital that we evaluate your life insurance and long-term care planning. The insurance world changes regularly, and you need to know that we're keeping you abreast of today's ever-changing environment.
The three biggest threats to our retirement savings is what we call the hit list. There's healthcare, inflation, and taxes. People can't afford to run out of money, so they have to plan for these things.
If you make smart choices about your money, then you have nothing to worry about.
No retirement plan is complete or properly constructed unless you have an estate plan in place.
We'll regularly bring in an estate planning attorney to speak with our clients to ensure that their estate planning is structured properly.
Today we see people with Social Security, no pension, and everything else in their retirement savings. The challenge is to turn that savings into retirement income that can last their lifetime, not subject to market fluctuations.
We want you to be confident. We know you can be confident. We've done it before. We can do it for you. All right, thanks again. Thanks for joining us. This is our episode of Chalk Talks. I want to talk about what Mike and I were talking about earlier, this how to use tax efficient tools. Again, I just want to reiterate, when is it you want to be paying tax on income? Think about that. When you're using it, right? Why do I want to have a case where I'm paying tax on income today that I don't really need till tomorrow? Right? The whole idea, the best plan would be paying tax on income when you're using it, when you need it. So in tax planning, being tax efficient is simply trying to find that proper balance and also what we would call utilizing the tax brackets efficiently as possible. Now I just want to show you a scenario. I was talking about this earlier, how we might find ourselves
in a certain tax bracket. But let's just say I'm that person that's got pension income, okay? I've got that. I've got Social Security income. Now look at that. Here's the top of the 12% bracket. Between the pension and the Social Security income, it's got me into the 22% tax bracket, meaning some of this Social Security is going to get taxed at 12%, but the amount that's above in that new bracket is going to get taxed at the 22%, okay? So then let's say I'm that person who has that money over here that I don't need for income, okay, but it's spitting out interest and dividends because it's non-retirement money, and I stack that on to this, and look where I'm paying tax on it at. I'm now paying 22% on income that I don't even need today. Okay, so maybe in our tax planning and our strategizing, one of the things we would want to maybe do is look maybe for some tax efficient accounts that we might be able to move this income to delay it into the future when maybe we need it at that time. Now, I want to give you another scenario that can potentially happen. Now, let's say I'm that person that has IRA money, okay, sitting over here. And now I want to maybe use that for income, okay? What's going to happen if I stack that income on here? Let's just call that RMD. Guess what rate I'm paying tax on that IRA at? Right here in the 22% bracket. Now, would it have behooved me to try to, in my earlier days, maybe when I, could have changed that or deferred that in some way by putting maybe more money into a Roth IRA? Certainly I would have wanted to do that. But here's another thing, and we talked about this earlier in our talk. All right, so I am going to have to pay tax on it on the 22% rate. But right now, for the next 8 years, that's 3% lower than it's going to be down the road. So maybe I'm that person that says, you know what? I'm going to have to pay tax on that at that rate anyway, and that's going to be a little bit lower than what it's going to be down the road. Let's possibly maximize that bracket here and potentially do some Roth conversions. Okay, pay the tax on it now at this rate, knowing that down the road I'm going to have to pay at the 25% rate. Can you see how that might be helpful? In tax planning, that's basically what we're doing. Now, Mike and I talked about this. There is a sweet spot out there right now if you're fortunate enough to be this person to have enough in your IRA accounts. But up to $315,000, when you compare it with the old brackets and rates to what they are under the new Tax Reform Act, there's a difference of almost 8-9%. So it can be much greater than this 3% by converting even more. So I might be that person, for example, that's already maximizing a 22% rate, maybe already up in the upper rate. Maybe I want to take advantage or at least look or analyze what does that look like if I, converted quite a bit more in these maybe next 7-8 years to get a majority of that IRA over into Roth IRA. Now, can legislation change this anytime between now and then? Certainly. One thing I get asked about all the time is, Larry, I didn't know that I could do what's called partial conversions of Roths. Everybody thinks that's an either-or kind of a scenario. I either got to take my IRA and convert it all over to Roth and pay the tax on it all at once, or nothing at all. But there's also this concept, as I'm indicating here, you can do what's called partial conversions. Let's say that I'm a person, I'm just going to use a rough number, but let's say I'm somebody that has $160,000 in my IRA. And I've got 8 years to work with here, okay, to convert it. Knowing what my tax situation is going to be, I decide that it is in my best interest to convert maybe only $20,000 per year. Maybe that's all I do every year to maximize this bracket. Well, in an 8-year period at $20,000 a year, I can convert my whole IRA of $160,000 over into a Roth by just simply doing it partially over time. Listen, in your retirement income planning, Everything has to work together. Taxes is a huge part of that. And the kind of analysis you want to do in trying to develop some kind of a strategy accordingly, what we would call a good tax plan as you take income or grow a portfolio, is vitally important. All the more reason that you want to come in and talk to us regarding it. Thanks. Have you ever heard of the 5% rule? Simple. Consistently earn 5% each year and then take 5% as income. Great, but in this new economy and market volatility, does it work? If I need 5% as income from my savings and the market drops 30% in 1 year, then the 5% I need now turns to 7.1%. Now I have to consistently get 7.1% or more or drop my income accordingly. If interested in a properly structured income plan, then please call the number on the screen.
Retiring Well is now also airing on radio, bringing you insights from Northern Michigan's financial advisors specializing in retirement planning. Every Sunday at noon on WTCM AM 580. Don't miss Retiring Well Radio, every Sunday at noon on WTCM AM 580.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
Hi, it's Michael Reese here. I have in my hands a copy of our #1 best-selling book on Amazon in its category, Retiring Well, How to Enjoy Retirement in Any Economy. In this book, we cover the 4 big areas of retirement planning: income planning, investment planning, tax planning, and estate planning or legacy planning. It has everything you need to know about your retirement plan, and I want to get you a free copy. So how do you get a free copy? It's really easy. Just call the number on the screen. Come visit with us. Come on in for a free, no obligation financial planning review. And when you come in to get your planning reviewed, we'll give you a copy, your very own copy of this best-selling book, absolutely for free. Again, just call the number on the screen. I want you to get your free copy. I know that you're going to love it.
Welcome back to Retiring Well. Thanks for joining us this week. I have John Torbett, one of the senior partners here at Centennial Wealth. I'm Art Canfield, and what a great show, talking about different taxes and paying tax on something, money you're not using. Right. And one of the things that comes to my mind, John, as we talk about Mike's new book, Retiring Well, here, and we read through this about how often in today's world we see people completely not paying attention to the different taxes that they're paying on their investments, whether that's pre-tax, post-tax, contributions, whatever it may be. So often there's just this disconnect with their investments and their taxes.
Well, and I think the big problem there, Art, is that people are relying on their financial advisor to be that resource, and not all advisors are structured, or their company may not be structured that way to handle those tax questions. So a lot of times you end up hearing, well, go talk to your accountant about that. And the accountant's so busy handling tax returns when they're going through things that they don't get a chance to really do a lot of tax planning. So that's where I think a lot of it falls, is having that resource or the advisor that sees taxes as just as important as your investment structure. I think they need to go hand in hand.
Yeah, I think of just the general concept of if somebody could save
a percent or two by doing some tax planning, isn't that just as good or maybe better than making a percent or two? You know, if you're making money and just turn around and giving it away, what's the point? And I know you and Larry and I and the different advisors here, we have so many stories we could tell over the years of really, I guess, tax planning blunders or lack of tax planning from folks coming in, right?
Yep. One comes to mind. I was on a phone call yesterday, and she was talking about how, well, she finally asked her advisor, because she's getting to 70.5 for those required minimum distributions from her IRA, and she finally brought up, okay, what should I be doing for tax planning? And lo and behold, the advisor said, well, I'll talk to the accountant, and the accountant sure enough said, well, you could have been moving, you know, X number of thousands of dollars. I think in her case it was about $12,000 a year that she could have been moving from her IRA over to a tax-free Roth IRA, and actually based on her income she wouldn't have paid any taxes on that money. So, you know, she had been retired since 60, so we're talking about 10 years, $120,000 ultimately that could have been moved to a tax-free vehicle like a Roth IRA, but those conversations just never came up until, you know, watching the show and hearing us talking about taxes over and over really finally caught her attention.
Wow. So, I mean, in that scenario, this person could have moved over $10,000-$12,000 a year, and let's say they could have did this for 10 years. So let's just say it's $120,000, and even let's say they had paid a low tax rate of 10%, which is probably going to be higher than that in RMDs. Right. You know, that's a significant amount of money that advisor really missed on, right? I mean, they just, from the lack of planning, that person now is going to be paying a higher rate, right?
And that's why we feel it's important. I mean, every year you need to be looking at taxes, and most definitely now between 2018 and 2025 with these new tax rates that are out there. So for those folks that may have been, let's just say, in the 15% tax bracket, that's now dropped to 12%, and we haven't seen those types of rates before. So that's something that we want to be looking at on a year-by-year basis to see, does it make sense to start transitioning some of this money? And now that's accelerating taxes, so you're going to pay tax on the money, but it's one where, would you rather pay tax now at this rate versus what you may pay 10 years down the road? And that's a big unknown.
Right. We talk a lot about, you know, on the show and in real life about planning, right? Income planning. You know, this might be, I guess, doesn't get all the attention many, but the tax planning may be one of the single most important plans that you should have in your retirement, because just in your example, it costs that person thousands of dollars by not having that plan.
Right. Oh, most definitely. And there's other things to be thinking of too, where maybe there's ways you can save taxes today, and so different, you know, retirement plans and things that you can be contributing into and getting some of those deductions, but that may be more important if you're in a higher bracket today with the expectation you'll be in a lower bracket in the future. But so often, we've been doing this for a number of years, and we see a lot of times people end up staying in the same or very similar tax bracket. So it's almost just kicking the can down the road, and you don't want to be doing that.
Right. Yeah. Thanks, Sean. What great information. Folks, if you don't have a tax plan, or your financial advisor is not talking to you annually about your taxes and what you potentially be saving, give us a call. It's really important to know, and maybe you could be one of these individuals that could save money by doing some tax planning. Give us a call, and don't forget, if you're interested in the book, come in and sit down with us and enjoy your free copy. Thanks for watching the show this week.